With almost 50% of the US population over the age of 18 being fully vaccinated as of May 24th, many businesses are having to make some hard decisions right now around the work from home policies that became the norm in 2020 and the first half of this year. Initially, this appeared to be very much an employer-based decision, with companies in charge of making choices around if and when employees would head back to the office. However, as we start to head back into a new normal here in the US, we're starting to see employees having a much bigger impact on this decision than research firms had initially projected, with many office workers now pushing back against a full or even partial return to the office move. And this is not a good thing for office property owners during a time when occupancy rates have dipped even lower than they were in the great financial crisis of 2008. Rent growth has turned negative nationally in the sector, and concessions like TI allowances and free rent periods are being used widely across the country in a last-ditch effort to preserve valuations on office deals. So with so much change going on in the office product type specifically, to help make sense of it all, in this video, we'll break down exactly where the work from home movement stands today, how that's affecting the office market right now, and the opportunities that might arise from all of this chaos for office investors going forward. So the numbers are in for office figures in the first quarter of the year, and things are not looking good. According to the CBRE Q1 2021 US office figures, the US saw negative net absorption of 34.8 million square feet in the first quarter of this year, which was the highest drop in a single quarter we've seen in this entire cycle, and vacancy rates rose by 3.7% up to 16% nationally. Major gateway markets like Manhattan and San Francisco saw the biggest drops in office demand, with Manhattan seeing almost 9 million square feet of negative net absorption during Q1 of this year. Markets like Las Vegas, Los Angeles, New York, and Orlando all saw quarter-over-quarter office using employment drop by over 7%, and metros including Dallas, Fort Worth, Chicago, Atlanta, and Hartford all posted vacancy rates for the quarter of over 20%. What was also some sort of a saving grace for office landlords was their ability to offer hefty TI allowance packages, multiple months of free rent, and several other concessions to prevent base rent values from slipping backwards in 2020, but this strategy looks like it has finally cracked too, with a 1.6% year-over-year decrease in asking rents recorded in the first quarter of the year. Again, gateway markets were hit the hardest in this category, with Midtown South Manhattan seeing a 10.6% year-over-year decrease in base rents, and downtown San Francisco seeing a 13.5% drop in base rents against Q1 2020 figures. According to Cushman & Wakefield's U.S. National Office Q1 2021 Market Beat report, the total amount of vacant sublease space across the country has more than doubled since March of 2020, from just 59 million square feet to over 123 million square feet, again indicating a massive decrease in demand for office space in the short term and a significant amount of tenants looking to make an early exit from their leases. And even though many of these subleasing decisions were inherently short-term at the time, these downsizing moves appear to now be reflecting the longer-term plans of many companies, which is being driven in large part by the desires of their employees themselves. In their 2020 Global Office Impact and Recovery Timing Report, Cushman & Wakefield estimated that the number of permanent work-from-home positions will more than double from 5% in early 2020 to 11% going forward, and the population of office workers coming into the office only part-time will increase from about 33% of workers up to about 50% of office workers going forward. But even though those figures represent a pretty dramatic change, the data we're seeing right now actually represents an even more dramatic shift, with only a very small fraction of workers actually coming into the office on a weekly basis. The company Castle Systems tracks swipes of their access controls on over 2,600 office buildings in 138 cities, and using data from the 10 largest cities in which this firm operates, the company found that average weekly occupancy in these markets was just 27.8% as of May 12th of this year, with metros like San Jose, San Francisco, and New York all seeing occupancy figures well below 20%. And as far as this changing anytime soon, even if employers want to see employees back into the office full time, employees seem to be pushing back against this in a pretty big way across the country. A study released in April from the job posting site FlexJobs surveyed 2,100 people who have worked remotely over the past year and found that 58% of workers said they would absolutely look for a new job if they were not able to continue working remotely in their current position, and 65% said they want to remain full-time remote workers indefinitely. 84% of respondents cited not having a commute as their number one benefit of remote work, and only 2% of those surveyed said that they would prefer to return to the traditional office setting on a full-time basis. And in a survey released by Ernst & Young earlier this month that polled over 16,000 employees globally across multiple industries and job roles, the study also found that more than half of employees would quit their jobs entirely if not allowed for more permanent flexibility regarding when and where they work, with employees on average wanting to work remotely 2 to 3 days per week indefinitely. More than 2/3 of respondents believe their employers could accurately measure their performance regardless of the location of their work, and 90% of those surveyed wanted continued flexibility in when and where they work. These two surveys also echoed a Harvard Business School survey from March, where 81% of the 1,500 people surveyed said they either don't want to go back to the office at all or would prefer a hybrid work schedule rather than full-time in-office work in the future. Office space has traditionally been used by companies as a place to send employees to get work done and for employers to be able to supervise that work, but employers also want to be able to attract the best talent they can for their organizations. Over the past 15 years, we've seen this attempt to attract talent show up in various different forms, from ping pong tables and on-site video game consoles to free meals and decked out fitness centers to most recently a creative open-air office environment where employees could collaborate freely, which is exactly what most employees do not want today and likely will not want for the foreseeable future. And if the most talented employees shift their focus from looking to work at companies with a host of different office amenities to a remote work environment where going into the office is optional, this will have a direct effect on leasing decisions among office users, creating a much more long-term reduction in office demand and sustained downward pressure on rents and occupancy across many major markets throughout the entire US. So this is potentially a lot of bad news for the office sector, but if work from home does stick around long term in a big way, the question becomes, how does this impact the office market going forward? And even if this is a doom and gloom scenario today, where are there likely to be opportunities for investors looking to get into the office asset class in the future? Well, first, tenants who are looking to increase their office footprint right now are looking to take advantage of some of the best deals on rent they may have seen since they started their companies in the first place. And with that, we are seeing and likely will continue to see what's referred to in the industry as a flight to quality in the office sector specifically, or tenants looking to relocate their spaces to newer, more well-located, highly amenitized buildings to capitalize on base rent values that have dropped 10% or more over the past year in some of the most attractive office markets across the entire US. This means that demand will likely be highest in the near future in the core central locations of a market or submarket, which also means that rents in these areas will most likely rebound more quickly than other areas in that same metro. Based on the data we're seeing today, it looks like rent drops will likely continue in these areas for the next 6 to 12 months, but for real estate investors looking to play the long game here, looking at deals in these types of locations could present a pretty attractive opportunity towards the end of 2021 and heading into the beginning of next year. Additionally, there may also be an outsized opportunity in these high-quality assets in secondary markets, specifically those seeing employment growth and positive net migration patterns overall. Cities like Austin, Raleigh, Tampa, Jacksonville, Salt Lake City, Charlotte, and Nashville all saw positive office-using employment growth through March of 2021 compared to the US as a whole, seeing a decrease in those employment figures of over 2% during that time. And stacking the flight to quality investment thesis within individual submarkets, along with looking at deals in growing employment markets with a lower cost of living and higher quality of life that people are moving to anyway, even for non-career related reasons, may also be another strategy that investors can take advantage of to buy some bargain deals at the bottom of this cycle. Overall, things are definitely looking rough for the office sector right now, but even if work from home sticks around long term, there will still be opportunities in the space. It's just going to look a little bit different than it did in 2019. And if you're looking to learn how to spot these types of opportunities and analyze and underwrite office properties, we just released a brand new, completely updated course on office investing, which now includes an industrial component as well. And I'll put a link to that in the description below. And if you want access to all Break Into CRE courses, all Break Into CRE models, and additional one-on-one email-based career support to help you break into the industry, make sure to check out the full Break Into CRE Academy program, and I'll link that in the description as well. And if you like this video and want to see more content like this on specific real estate property types, make sure to hit the like button to let me know so I can create more of these videos, and let me know in the comments where you see the office market going in the future and if you think work from home is here to stay or not. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.